I want to start with the fact that we are in Los Angeles, and there has been a lot of discussion about the protests and some of the military presence. And there's a real question as investors how much some of these types of political backdrops and social backdrops affect where you invest. And Tim, I'm curious to what degree it really is affecting the flow of investment.
I think the primary driver, if you just want to look at Los Angeles, of investment here is, where the economies are very active, right? And so what you're seeing in LA is downtown LA, where some of the protests are. That office market is under a tremendous amount of strain. You're seeing buildings that are now selling for less than they were sold for in 2014. You go 10 miles to the west where we are, or maybe just to south of where we are in Century City and Culver City, and you're seeing new offices being built because that's where the demand is. So I would say it's much more a function of the economy than it is political events.
Yeah, and I'd say, why there are these kind of things going on, it's not like the war zone that people make it out to be. LA is a big place. There's some issues that are, currently happening that tend to be pretty localized.
Yeah, well, there is this question on a broader level, just how much the political backdrop has changed, not only where you want to invest, but also where your investors want to invest, and whether over the past 6 months or even 6 weeks, you feel like some of your investors have been shifting gears about where they want to be invested. Is it still the United States? Is it more outside of the United States?
I think across the board, there's significant demand for investment here in the U.S. There's a large trend towards kind of private credit taking market share away from the commercial banking system. And we've seen that in a number of different products, whether that's real estate, private credit, forward flows, consumer finance. And it's we think it's a terrific opportunity. We think it's kind of a long-lived opportunity and one that we're going to be investing in for a significant period of time. And at the same time, we're seeing lots of opportunity in Europe. We're seeing great continuation of investing of our Japan franchise. So we're pretty active all over the world now.
Yeah.
Lisa, at the end of the day, investors go to where they're going to get the best returns. And there are still incredible opportunities here in the U.S., but also in the other markets that Lisa mentioned, or that Josh mentioned.
When you talk about the United States, are you talking residential, you're talking commercial? Is there, within the residential market, more room for some of these private asset managers at a time where there's an increasingly stagnant market in some ways because of mortgage rates?
Oh, I think there's a lot of opportunity in the residential market. It's actually, for example, we're one of the largest purchasers of tax liens in the U.S. And those are very, very attractive risk-adjusted returns. You're generally buying those at about a 10% yield for being less than 1% loan-to-value. We're interested in buying mortgage servicing rights, particularly those mortgage servicing rights where the coupons are below 4%, which are unlikely to be refinanced for a long time. So there's opportunity everywhere in residential.
And on the commercial side, try and get a construction loan today from your bank. It's very, very hard. We're filling that gap. Not only are we filling it through our own lending products, but other parts of our business. For example, our net lease business does a lot of build-to-suit now. We're probably doing more build-to-suit product, particularly in things like technology, data centers, things of that nature, than we have ever done in the past, because it's hard for these developers to get financing on a construction basis.
Tim, you used to be CEO of Wells Fargo.
Yep.
It strikes me that a lot of what you're talking about that you're doing right now is somewhat similar.
Very similar.
To what you were doing there.
Very similar.
How is it different, and how much do you see it actually taking over a lot of the roles that you used to have?
I think Josh mentioned the disintermediation of the banks with private credit. We saw that in corporate credit over the last 10 years. We've created a $1.7 trillion industry. We think that's going to happen in commercial and residential real estate. It's happening right now in the growth of our business. And all that's happening is that the riskier part of the lending book that banks have historically done is moving to private credit. The good news is the banks are providing us with our financing to be able to make those loans. Because when you look at the largest category of loans that are growing on the balance sheets of the largest banks in this country, country, it's loans to non-depository financial institutions. That's 12% of the banking sector today.
So, Josh, I'm curious where we are in that cycle of the disintermediation, given the fact that that was the story for the past number of years. And then now there's this real focus on deregulating the banking sector, which would allow them potentially, unshackle them to go back into these businesses. I mean, at a certain point, is there going to be that kind of competition?
I mean, there could be. I mean, this is, I think what you're seeing with private credit is absolutely here to stay. The private credit market itself is going to be a $6 trillion market in 5 years. I mean, you're not only seeing us disintermediate banks, but other types of financing in the market. Things have been moving away from CLO financing, for example, into private credit. So those are all trends that we think are going to continue. And now with kind of real estate emerging as this large private asset as well, we think there's great opportunity there.
You keep using the word opportunity. It doesn't mean that things are going to be going swimmingly necessarily in terms of prices going up or valuations going up. I am curious where you think we are with respect to that, given the fact that rates are high. The volume of sales has fallen off a cliff to the lowest levels that we've seen in more than a decade. And there's this feeling of stagnation. Do you have a sense of where we are?
Well, I'd say, Tim and I have both been through our share of financial crises and restructurings. And the past couple that we've had, whether it's the pandemic or the global financial crisis, those were kind of unusual crises at the end of the day because the central banks came to the rescue and they flooded the world with liquidity. Asset prices were buoyed up. What we have today, I think, is a more normal type of, recapitalization or restructuring of the banking system, of the real estate markets, and that takes time. That's going to take, 3, 4, 5 years to ultimately get from point A to point B.
Because this cycle was primarily driven by rates. Your point about rates growing up. Now, I remember when I got my first mortgage and it was 13%, and it wasn't the end of the world.
Prices were a lot lower then. Yeah, so it's a very different market, but carry on.
My salary wasn't at the time, but that's another topic. But I think the point that we're making is that we think that this cycle is going to be elongated because it wasn't necessarily driven by overbuilding. Right? It's not being driven by a pandemic. It's not being driven by a decline from a recessionary environment. It's really driven by rates. And so what we're seeing is that the banks slowly but surely are moving back from providing commercial real estate loans. We're stepping in, and they're slowly but surely working off the portion of their portfolio that's really not performing as well.
We say the banks are amortizing their problems away, and that's going to take time. It's because they're not re-injecting that capital out into the markets. They're using it to build up their reserves, to get in a position to sell assets, hopefully to us eventually at distressed levels, which we like doing as well. But
how many trillions of dollars of assets do you estimate are going to be moving from the banks to the private market?
I don't know for sure, but I think one of the statistics that we look at in the commercial real estate world is over the next 4 years, there's $4.5 trillion of loans that are going to maturing. And they've got to find a home, right? So could it be $1 trillion? Could it be $2 trillion? Absolutely.
There's a question on a larger basis, and we've been talking to a lot of investors about this. We talked a little bit about how you're expanding in Europe and you're expanding overseas. Josh, congratulations. You're moving from Dallas to London, I believe. What's behind that? I mean, do you see that as sort of a more ripe opportunity for investment right now than even the United States?
Well, there's a bunch of reasons. The investment piece is certainly an important one. We think there's great opportunity not only in our real estate franchise over there, but also in our private credit business. We have been expanding and pushing hard into private credit and lending, but we also think that we can look at the fundraising side of it as well. Not only our institutional capital, but private wealth is a growing sector of our business like everybody else's, and something that we have kind of zero presence in Europe currently.
Well, I guess that, to ask that in a more pointed way, and I'll ask this of you, Tim, at a certain point, has some of the policy uncertainty caused a greater degree of reluctance to make long-term commitments in the United States in certain areas because that adds a certain risk premium that maybe you're not getting compensated for? Do you see that on a global scale?
Absolutely not.
Okay, so that's not the case. Nope. Where is your fastest expanding place? I'll leave with that.
From a
Yeah, in terms of Fortress's presence geographically, where are you expanding?
I mean, we're going everywhere. We just opened an office in Abu Dhabi. Our office in London is going to be doubling, almost tripling in size over the next few years. So there's a ton of activity in Dallas. We're 150 people now. We think we're going to be 200, by the end of next year, the year after. So we think there's an incredible amount of opportunity for us, particularly as the markets kind of stay, unsteady to a certain extent, and we can deploy capital in really interesting ways.